Unlike some stablecoins which are fully backed by currency reserves, Terra's UST stablecoin was backed by an algorithm linked to its sister token Luna. The price of UST soared in the last 6 months due to a platform called Anchor, which offered a 20% yield to anyone who bought UST and lent it to the protocol. Critics called it a Ponzi scheme, but the price rises were too much to resist, and the red flags were ignored.
There are groups of people who have warned people who participate in it, saying that you cannot hack a stable crypto with an unstable one. And it may work when there is upward pressure of the stable coin, but it may not work when it's dropping, which is what happened this time around. And I think the euphoric of seeing the rise of Luna price, I think it was, I think the launch price was 12 cents or 15 cents. And now at one point it was 120 US dollars just last month. And there are people, as of now, I think it was 0. I don't know how many zero there are, it's evaporated.
Some experts blame short sellers for causing the UST to depeg from the dollar, but the result was catastrophic. Investors scrambled to sell their USTs before it was too late. The ensuing death spiral caused the linked currency Luna to crash too. Luna is now worth a fraction of a penny after hitting nearly 116 US dollars in April. The crash impacted the rest of the crypto market as well. The contagion briefly spread to other stablecoins, and even Bitcoin hit its lowest point since December 2020.
What it has shown, though, is that the cryptocurrency market is built a lot on hype. It is built on the notion that coins will continue to increase in value. Now, when they start to depress and go the other way, that causes a ripple effect across all cryptocurrencies, Ether, Bitcoin, XRP. One thing that retail investors do not understand is that this market is really guided by the hedge funds. It is not a retail place to be. In fact, you're floating on the top of the ocean when you're investing in cryptocurrencies. And to that extent, the MAS has done a good thing in banning retail marketing. But the hedge funds are the ones that create the volatility, and the hedge funds are the ones that make the profit from this market.
Crypto investor Lai Yin was one of those who ignored the red flags when it came to Terra.
At a very basic level, I try to limit my exposure to any one token or ecosystem to about 20%, 15%. I got greedy with Terra. I let it go way past my safety limits. At the start, I viewed the 20% yield as a customer acquisition cost for the system. And this worked well because it led to Terra rising to accounting for about 10% of all of crypto total value locked across multiple chains. Yeah, so things really started becoming questionable when most of the value lock was just locked inside Anchor, and that actually posed a lot of sustainability questions for the ecosystem as well. The mistake made here was that we all subconsciously knew that we were playing a game of musical chairs, but we just didn't want to admit that the music was slowing down and continued playing.
Lai Yuan says he lost a low six-figure sum, roughly equivalent to the price of a sedan car in Singapore. But he is thankful that they were paper losses. Many other investors had their savings wiped out or incurred debt due to borrowing cash to cover their losses. He has this advice for crypto investors.
So you need to only put money that you're okay to risk at risk, right? The second thing is that we need to be able to measure our portfolio value in terms of the bottoms, not the tops. I say it's because a lot of the fever that got on was actually users who, or investors who had a preconceived notion that, oh, they used to be a millionaire, for example. So a lot of them were trying to buy the next big thing to get back their millionaire status. So that's actually one of the big reasons why a lot of people are on leverage and were buying Luna on debt and depositing it in Anchor. The third advice I think that should be made known is that at the end of the day, we owe it to ourselves to do proper due diligence. Don't be afraid to ask more experienced people in the space.
Proponents of crypto are optimistic that the digital assets will emerge stronger from the aftermath, as it has done in the past.
I mean, of course, it is a tragedy when a crypto evaporated. But at the same time, when you reach out, seeing what are the crypto community talking about, and you see how people are trying to come together to make good some of the losses, I think that's positive for me, and that's what I love about it. It's always community above blockchain. Yeah, and I think that's what is keeping me as well in the whole industry, with knowing that this decentralized finance is going to be one of the key pillars of Web 3.0. Again, it's not going anywhere. It can only become stronger, and some of the lessons that we are going to learn.
In the wake of the Terra crash, some are calling for more government or regulatory oversight into cryptos.
Currencies should be regulated, just like e-money licenses or digital banks. That's one. Secondly, we believe there needs to be proof of real economy reserves of liquidity and cash that support the cryptocurrencies. As an industry, both the crypto industry and financial services, the legacy, we need to take a step back first, I think, and take the learnings, put protection in place, and recognize that the free market, by virtue of algorithmic stablecoins, is really not a good place to be. It is not exactly free. It's going to require some more central organization and protection, not just for the investor, but because the next time this will happen, it'll be larger and it'll actually impact our real economy, financial stability.